4 times a year, the stock market becomes a game, and I'll show you exactly how to win. Welcome to State of the Market. I'm Marc Lichtenfeld, your Chief Income Strategist at the Oxford Club. Earnings season starts in 2 weeks. You know what that means.
It's the most wonderful.
Yes, if you're a subscriber, you know I used that clip last week to describe tax season. Well, last week I was being sarcastic. Everyone hates tax season. Even my friends who are CPAs who make most of their money doing taxes hate it. But earnings season actually is the most wonderful time of year, as you'll soon find out. By the way, if you missed last week's video on how to make tax season much more bearable, subscribe to this channel to make sure it never happens again. It's absolutely free. Just click that subscribe button. So, why do I like earnings season so much? Well, it's real simple. Take a look. This is what can happen when a company beats earnings expectations. This is Omnicom. And you can see that after it reported better than expected earnings, the stock spiked 14% in one day. And keep in mind, this isn't some super speculative tech stock. This is an advertising company that pays a decent dividend. In other words, it's a mature, established company. And yet the earnings beat was like spurs on a horse, making the stock gallop higher.
Giddy up.
Let me be clear, for long-term investors, you don't need to worry too much about each quarter's earnings. I mean, sure, you want to pay attention and make sure the fundamentals of your stock are not deteriorating, but if you plan on owning a stock for years, any individual quarter's performance and stock price movement is inconsequential. Think of earnings like your yearly physical. If you can still human properly, then there usually isn't a need to go back to the doctor the following week. But for shorter-term investors and traders, earnings releases can be major catalysts for your stock. At the very least, you should know when your companies are reporting so you can be ready to take action. Savvy traders will play earnings to their advantage, getting in before an earnings beat and getting out after the price moves higher for a quick gain. But I'm getting ahead of myself. What do I mean by earnings beat?
What the hell is even that?
Daddy, chill. Let me explain. Many stocks, not all, but many have Wall Street analysts that cover them. And these analysts have buy, hold, and sell ratings, and they forecast what the company's earnings per share, revenue, and sometimes other metrics will be for the quarter and full year. Now, for each company, those numbers are averaged, and it's called the consensus. So if XYZ has 2 analysts covering the stock, and one expects the company to earn $1 per share, and the other projects $1.50 per share, the consensus or average estimate is $1.25. Now, the larger popular companies could have 20 or 30 analysts all making predictions on how much money the company will earn and generate in revenue. When a company reports earnings that are better or worse than the consensus, the stock price can move sharply. That's because stocks are typically valued based on those earnings expectations. So if the company is now making more or less money than expected, it will be revalued and the stock will move accordingly. So that's all well and good, but how do you find companies likely to beat earnings expectations? First of all, I want profitable companies. Sure, an unprofitable company could jump on a revenue beat, but for the most part, I'm not interested in a company that's forecast to lose $1 per share, and I hope it only loses 90 cents. Unless revenue comes in way ahead of expectations, the stock isn't likely to do too much. I'm more interested in the stock that's expected to earn $1 per share and instead reports earnings per share of $1.10. I'm also going to look for companies that have a history of beating expectations. And here's why, and this is important. The analysts come up with their estimate from management's guidance. A CEO may tell Wall Street, we're going to earn between $2 and $2.25 per share this year. So the analysts crunch their numbers and probably come up with a consensus estimate that's going to be right in the middle, around $2.13. Very few analysts will forecast earnings below $2 or above $2.25 if management told them to expect differently. Now, if the company reports earnings below $2, that shows that management does not have a good read on its business and how to manage Wall Street. You always want to underpromise and overdeliver. That way, when the company reports earnings of $2.30, crushing the consensus of $2.13, the CEO looks like a genius and the stock pops. It's all a game.
I love games. Pick me.
So I'm looking for a management team that knows how to play and win that game.
You play to win the game.
Here's another very recent example. A few weeks ago, Lululemon reported fourth quarter earnings of $3.37 per share. 10 cents better than Wall Street expected. Not a huge amount, but in this case, size doesn't matter. I've heard that somewhere before. Anyway, the stock exploded 33 points higher, or just about 10% in one day. Lululemon's management knows how to play the game and they know how to win. They did it again last September, and the stock rose 40 points, or nearly 11% in one day, when it beat second quarter expectations. In both instances, investors earned a year's worth of stock market returns in just one day.
Dollar bills, y'all.
If you're a short-term trader, learning how to play earnings season is vital for improving your performance. For more information on how to pick the stocks that will crush earnings this season, and which ones I'm looking at, click the link in the description. Thanks for watching State of the Market. I'm Marc Lichtenfeld.